All right, so last time we had two worksheets to complete. We had the 2.2 tax bracket worksheet and then the 2.99 unit to review. All right, so we'll go through each of these. So the first worksheet, the income tax brackets, numbers 1, 2, 3 are single filers. And so we're given this tax bracket, we're given these percentages and the ranges. All right. And so if we're a single filer, we're going to be focusing on this middle column here primarily. Number 1 says Felix has a gross income of 18,000. What is his taxable income? Okay, so for Felix, we're going to take the 18,000 earnings minus the standard deduction. In this case, it was 12,400, which leaves us with 5,600. All right, all 5,600 falls into that 10% bracket. So this calculation is relatively easy. 10% of 5,600 is $560. Number 2, Serena made 42,000 in the calendar year. What is her taxable income? Okay, so she is going to have 42,000 again, minus the standard deduction of 12,400 is 29,600. All right, now calculate the total tax that she owes. So that 29,600 is going to fall here into the 12% bracket. So she's going to fill up that entire first bracket of 10%, and then the remaining dollars are going to go into the 12% bracket. All right, so the 10%, she's going to fill up that first bracket, which is $98.75. Okay, 10% of that is $987.50. And then for the 12% bracket, we're going to take the last taxable dollar that she earned, $29,600, but we need to subtract out the dollars that didn't fall into that 12% bucket. Instead, we're in the 10% bucket. All right, so we need to subtract out that $98.75 that went into the 10% so that we can isolate the dollars that are being taxed at 12%. So 29,600 minus the dollars that were already taxed at 98.75 gives us 19,725 in that bracket. All right, 12% of that is 2367. And then we add that up, we get 3354.50 rounded to the nearest dollar is 3355. Number 3, Kennedy has a gross income of 95,000. What is their taxable income? So we'll take the 95,000 again minus the standard deduction of 12,400 means that they earned $82,600 in taxable earnings. All right, 82,000 falls just short of maxing out the 22% bracket. So they're going to fill up the 10% bracket. They're going to also fill up the 12% bracket. And then the remaining dollars are going to go into that 22% bracket. So for the 10%, again, they fill it up, $98.75. 10% of that is still $987.50. The 12% bracket maxes out at $40,125, but we need to subtract the dollars that went into the 10% bracket. So minus $98.75 leaves us $30,250. 12% of that is $36.30. And then all the remaining dollars up to the last dollar that's taxed, $82,600, minus the dollars that fell into one of the two earlier brackets. So we had 9,800 in that first one, about 30,250 in that second one. So altogether, it's going to be that 40,125. We need to subtract those dollars out again, so that we're isolating just the dollars in that 22% bracket. So 42,475 fall into that bracket. 22% of that is 9344.50. We add those $3 amounts up, and Kennedy owes 13,962. Finally, number 4, Alex and Tori are married and filing jointly. Their gross income is 150,000. What is their taxable income? So now we have to look at the final column in this tax table, the married filing jointly. The percentages stay the same, but the dollar amounts in each range have increased, and the standard deduction has doubled to take into account the fact that we have two people filing together. So for Alex and Tori, they're 150,000 minus the standard deduction in this case of 24,800 means that they earned 125,200 in taxable earnings. All right, 125,000 falls in the 22% range. Okay, so some dollars are going to be taxed at 10%, some dollars at 12, and some at 22. All right, mathematically, They fill up that first bracket, 19,750 times 10% is 1975. They fill up that second bracket. We can look up here. It maxes out at 80,250. All right, but it starts at 19,751. So we need to subtract out the 19,750 that aren't in that range. So you subtract that out, and that range becomes $60,500. 12% of that is $7,260. The remaining dollars are taxed at 22%. So they max out at 125,200 minus the 80,250 that were in the previous brackets. Means that 44,950 fall into that third range. 22% of that is 98.89. We add that up together, and they owe 19,124. Okay, moving on to the last page, presented just slightly differently. Okay, we have different dollar ranges. We have different standard deduction. So number 5 says, what's the taxable income for a single filer with 42,000 gross income? In this case, we would take their gross earnings, 42,000 minus the standard deduction to get taxable earnings. The 42,000 minus the standard deduction on this bracket is 12,450, leaving them with 29,550 in taxable earnings. What's that person's marginal tax rate? 29,550 falls into the 12% range here. All right, and then how much do they owe? They're going to fill up that first bracket. So 10% of 9950 is 995. All right, and then they don't fill up that 12% bracket. So we're not going to go to that max of 40,000. We're going to stop at the last taxable dollar they earned, 29,550, but we need to subtract out the dollars that were taxed at 10%. So we subtract out that 9,950, leaving us with 19,600 in that second range. 12% of that is 2352. We add that together, we get 3347. All right, last one. Taxable income for married couples filing jointly with a combined 84,000 gross income. Married filing together has a standard deduction, in this case, of 24,900. We subtract that out. We're left with 59,100. Looking up at the bracket, 59,100 again falls into the 12% range. Okay, so their marginal tax rate is 12%. So the calculation, 10% of the entire first range, which was 19,900, gets us to 1,990, 12% of the remaining dollars. So again, maxing out at 59,100, their last taxable dollar that they earned, minus the dollars that were already taxed at the lower percent, so minus 19,900. That gives us 39,200. 12% of that is 4,704. We add that up, we get 6,694. Okay, so that's the first worksheet. And again, it was heavy on the actual tax calculations. There were some questions just kind of making sure that we understand what a marginal tax rate is, right? That's the last taxable dollar that they earned, whatever percent that's being taxed at. Okay, but it's primarily we were looking at the calculations. No, so if you've gone through the last couple of days and you're still feeling like, oh man, I don't really get this, I don't understand the calculations, you can still do very well on this standard. Okay, the 2.2 standard is all about taxes. It's not just calculating the tax burden on a federal income tax. Okay, so if you can still describe the key concepts from this standard, if you can describe the difference between a marginal tax rate and effective tax rate, if you can describe the difference between a progressive tax and a regressive tax, if you can talk about the advantages of progressive taxes versus the advantages or disadvantages of a flat tax. Okay, if you can recall the differences between payroll taxes and income taxes and the percentages that are applied, particularly with those payroll taxes, the FICA taxes. All right, if you can understand the concepts, you're still in great shape for this standard. Calculating the tax due using tax brackets, that's what separates a 3 to a 4, and that's it. So even if the math behind here, if you're struggling, if that's confusing you or feels intimidating to you, all right, you can still do very well. You can score up to a 3 and not get any of the math behind it correctly. Okay, so I don't want you to feel like this standard, if you are struggling with it, and I get that it can be daunting at times, working out those tiered brackets, okay? If you feel intimidated by that, it doesn't mean that you're doomed on this standard. All right. So getting into some of those more conceptual ideas, right? We've got the 299 unit review. This walks through just the first page is just making sure that we understand concepts, right? Understanding key terms and similarities and differences and so on. And then page 2 and page 3 gets into the level 3, level 4 type questions. That's actual the calculations. All right. So number 1 here, looking at the distinctions between wages and salaries and what are some advantages or disadvantages to each. Okay, so wages are paid on an hourly rate. So if you're paid by the hour, you're earning an hourly wage. All right. The advantage to being an hourly wage earner is that you have the potential to earn overtime. All right. You have a little bit, you potentially have more control over how much you earn because, I mean, obviously, depending on the job and depending on the employer, you may be able to pick up shifts to increase your income. If you work beyond 40 hours, right, you'll earn overtime pay, which is 1.5 times your typical hourly wage. All right. So hourly wage earners have some more flexibility. Okay. They have potential to increase their earnings by working additional hours. And if they work so much that they work overtime, right, they get quite a bit of a boost in terms of their hourly wage. Salaries, on the other hand, are a yearly amount that is then broken up into equal amounts per pay period. So whether that's weekly or monthly or semi-monthly or whatever, right? Our earnings are described as an annual yearly amount and then is broken up accordingly into the pay period. Advantages of a salary payment, right? Makes it really easy for budgeting because you can consistently predict how much money you're going to earn each pay period. All right. Whereas with hourly wages, if you have a job right now, particularly like in retail, it can vary week to week, how many shifts you get, how many hours per shifts you're scheduled, right? And so that can create some uncertainty and lack of consistency when you're planning out how much money you're going to earn. So when it comes to budgeting expenses and budgeting how much you're going to put toward certain costs, right? Having an hourly wage, unless you work consistent schedule every week, right? Or unless you're guaranteed X number of hours, can be a little bit more difficult for budgeting, whereas salaried earnings is a lot easier for budgeting. All right. Number 2, describe key factors and discrepancies between total earnings and take-home pay. So discrepancies just means differences. So in other words, it's asking why would there be a difference between what you earn and what you are actually paid in terms of your net wage or your net salary. Okay. And so those differences arise because of our deduction. So the amount that we earn, our gross pay, is going to be higher than what we actually receive in terms of a paycheck or a deposit because some of our earnings get deducted out. Some of those deductions are mandatory, right? We have 2 income taxes, our federal income tax and our state income tax. Those are going to be taken out. We have 2 payroll taxes, Social Security and Medicare. Those are going to be taken out. And then we can opt to have additional money taken out. We can have these voluntary deductions if we're purchasing our medical insurance through our employer, right? That cost will be deducted. If we choose to enroll in a employer-sponsored retirement account like a 401k or a 403b, that could be deducted from the paycheck. All right. If we're putting money into a flexible spending account like a health spending account or child care, right, or dependent care, those can be deducted pre-tax. All right, so all those deductions would take us down from our gross earnings down to our net earnings. Okay. Number 3, calculate the net pay for an employee with a gross pay of $2,500, deductions of $350 for federal tax, $150 for state tax, $155 for Social Security, and $50 for Medicare. So in this case, our net pay is equal to our gross pay minus our deductions. Our gross pay was $2,500. Our deductions total $705. So 2,500 minus 705 leaves us with net pay of $1,795. Number 4, calculate net pay for an employee with a gross pay of $3,000, deductions of $450 federal tax, $200 state tax, $150 for FICA taxes. So here we didn't split up the 2 payroll or FICA taxes and do Social Security and Medicare. They're lumped together for this equation. All right, but just understand the FICA taxes are those Social Security and Medicare taxes. but the process remains the same. Our net pay is simply our gross pay minus our deductions. Our deductions are 4,500, 450, 200, 150 altogether. That's $800 being deducted for our taxes. So $3,000 gross pay minus 800 leaves us with net pay of 2,200. Number 5, explain various components of compensation in the workplace beyond an employee's base wage or salary. So we know that compensation is anything an employee receives in return for their labor and their time and their effort toward their job, right? And so the largest part of our compensation package is going to be our wage or our salary, but there are ways that we can receive additional compensation. Some of it can be an additional pay. If we receive bonuses, if we receive tips, if we receive commission, right? All of that will add to the amount of actual dollars that we're bringing home. All right. But our compensation isn't limited to only dollar amounts. We can receive non-wage compensation. All right. These are things other than just money that we can receive for doing our job. So if we purchase our health insurance through our employer, they may contribute to the cost of that purchase. We don't see that in our paycheck, but it does reduce the amount that we have to pay for that service. All right. Sometimes employers will put money into a retirement account on your behalf. So it's not money that you're electing to put in out of your pay. It's additional money that the employer is paying directly into that account. Doesn't change how much you receive into your checking account or on your paycheck. But again, it pays off huge down the line, 10, 20, 30 years when you get to retirement. All right. Other types of non-wage compensation would be paid days off, vacation days, sick days, and so on. All right. If you have a job that requires a relocation, sometimes they'll pay moving expenses or relocation costs. So there can be a lot of things beyond just your base wage or your base salary that you may receive as part of your compensation package. Number 6, detail the method for calculating overtime pay for hourly workers, specify typical factors that determine it. So your overtime, you receive overtime pay if you're an hourly wage earner and you work more than 40 hours during a week. Okay, and the law specifies a work week as Sunday through Saturday. So for the purposes of calculating your 40 hours, okay, if you take on, if you worked more than 40 hours between Wednesday and the following Tuesday, that doesn't necessarily mean that you're going to get overtime pay because the overtime pay is calculated from Sunday to the following Saturday. All right, but within those 7 days, if you work more than 40 hours a week, any hour beyond 40 gets paid 1.5 times your normal hourly rate. All right. So anything beyond 40 hours is 1.5 times the normal rate. And so then to calculate our overtime pay, we simply take the number of hours beyond 40 that we work. So the number of overtime hours times 1.5 times our typical hourly wage. Number 7, describe at least 2 variables that could influence the amount of federal income tax withheld from an employee's paycheck. So one of the things that I saw as some students were turning this in is a few of you mentioned, well, maybe you live in a different state. Maybe you live in a state that doesn't have a state income tax like Nevada or Florida, right? And while, yes, you're thinking about ways that people's tax burdens may be different, the question asks specifically about federal income tax. So we're not going to use differences in state income tax for this because federal income and state income taxes are different. So thinking only about the federal income tax, right? The amount that we pay, the biggest factor in that is how much we earn. All right. So differences in our earnings could impact how much we owe in federal tax. All right. Our filing status is obviously going to have an impact as well. If we think back to the previous worksheet that we looked at, if I am a single filer, right, my tax brackets are going to be significantly different than if I am married and filing together with my spouse. For example, if I earn, let's say, $60,000, all right, or $60,000 in taxable earnings, right, and I file on my own, I'm going to be in the 22% bracket. Whereas, let's say that I make that same $60,000 and I'm married and my spouse doesn't work. She or he is a stay-at-home spouse, right? That 60,000 now all of a sudden, when I file with my spouse, is only in the 12% bracket. So the same earnings is going to be taxed very differently if I'm married and filing jointly, if that's my status, versus if I'm single. If I qualify for head of household status, right, that's going to change the tax brackets and my deductible amount, my deduction. Okay, so your filing status impacts that. We didn't talk about the others quite as much, but when you first get a job, you have to fill out a W-4. On that W-4, you indicate the number of dependents that you have or other allowances or exemptions. All right. And so that can also impact how much is taken out on a per check basis. Okay. But by far, the two biggest factors that influence how much taxes you'll pay is the amount of earnings and your filing status. All right, number 8, differentiate between progressive tax and a regressive tax. So a progressive tax, as the name suggests, progresses or advances in such a way that as your income increases, the taxable amount that you pay and the tax percent increases as well. So our federal income tax is an easy example of this. As our income goes up, we fall into higher and higher tax brackets and we pay higher and higher percentages in income tax, right? 30 some odd states have a progressive state income tax as well. All right. The idea behind those, the advantage of this is that it's based on fairness and ability to pay into the system. So those who are high earners, okay, can more afford to pay back into the system that has enabled them to be a high earner. Whereas low earners, a larger percentage of their earnings are going toward their necessities, right? And so they can less afford to pay back into the system. And so a progressive system is designed to take that into account, to adequately measure the ability to pay. A regressive tax works the opposite way. Rather than advancing and increasing the percent that we pay as our income goes up, it stays the same. Okay, so this is also, when it comes to income taxes, it's also referred to as a proportional tax or a flat tax. All right, so the percentage remains constant regardless of your level of income. So sales tax would be an example of this. Property tax would be an example of this. Okay, it doesn't matter how much you earn, those are going to be the same. All right, when it comes to applying it to like income taxes, we know that, you know, a dozen or so states have a flat state income tax. Again, the idea behind this is rather than focusing on fairness, it's looking at equitable, right? Everybody is treated equally. They pay the same percent. Our payroll taxes, the FICA taxes of Medicare and Social Security, are flat taxes, are regressive taxes. All right, everybody pays 6.2% into Social Security. Everybody pays 1.45% into Medicare, regardless of the level of income that you earn. All right, number 9, differentiate between a marginal tax rate and an effective tax rate. So the marginal tax rate is the tax bracket, the last tax bracket that your earnings fall into, right? Remember, marginal means additional. So it's the percentage that the last additional dollar that you earned was taxed at. All right. And so again, with progressive taxes, your earnings go up, you fall into higher and higher tax brackets. Okay, those percentages go up. Whatever that last bracket that you fall into is, that's your marginal tax rate. Effective tax rate, on the other hand, though, is your average tax rate. So it's the average amount of tax that you paid on every dollar that you earned. All right. And so remember, the effective rate is always going to be less than the marginal rate. Your marginal rate is the highest percent that any of your dollars were taxed at. The effective rate is going to average out not just that high percent, but any of the lower percents preceding that, right? So some of your dollars aren't taxed at all because they are tax-free with that deduction. Our current federal income system, right? Some of your dollars then will be taxed at 10%, some will be taxed at 12%, even if you get into the 25% range or the 37% range even, right? And so the average is always going to be averaging smaller numbers with that large number, bringing the effective rate down. So the effective rate will always be lower than your marginal rate. And to calculate that, to calculate the effective rate, you would take the total amount that you owe in that tax divided by the total dollars that you earned, not just your taxable dollars, but your total gross income. Finally, on this page, number 10, define FICA taxes and specify the percent withheld from an employee's pay. So your FICA taxes are the two payroll taxes, right? And again, named because both parties to the payroll pay into the system. So both the employer and the employee. The two taxes are Medicare and Social Security. Employees pay 6.2% into Medicare, or I'm sorry, 6.2% into Social Security and 1.45% into Medicare. The employer matches that. So in total, 12.4% is going into Social Security, but the employee is only putting half of that, 6.2%. 2.9% in total is going into Medicare. The employee pays half that, 1.45%. All right. So again, if you can understand the differences, particularly in these questions about taxes, okay, you're in really good shape to do well on 2.2, even if you're struggling with the math behind it. All right. With 2.1, it's all about earnings, making sure you understand the differences between gross and net pay, understanding the differences between wage and salary, understanding different pay scales or pay schedules, right, and so on. So now we're getting into on page 2, the calculations here. So we are given this pay stub for Richard Belding from Bayside Community School District in California, right? We're given information regarding his pay on this paycheck. His regular pay, his gross pay was $49,3750. All right, year to date regular pay was $88,875. Keep in mind, year to date is not an annual salary. Okay, an annual salary is how much will you earn during an entire calendar year. Year to date simply means how much have you earned so far this year. So in this case, this paycheck ends for the period of September 30th. So this 88,000, right, is what he has earned up through the end of September. He still has 3 more months of earnings though. Okay, so that is not his yearly salary. And I'll give you a heads up. That's one of the more common mistakes that we'll see on tests, is that there may be a question about an annual salary, and almost always if there's a mistake, it's because somebody puts down their year-to-date pay. That's only asking how much have they been paid so far during the year. It's not their salary. All right, then we get into the deductions on the current paycheck, and then deductions for the year, again, so far. That's not how much will be deducted for the entire year. It's only so far, and in this case, through the end of September. So we're given 2 questions. What's his net pay per month and what's his annual salary? Again, anytime we're asking about salary, that's asking about gross pay. All right. And so in order to answer these 2 questions, neither one of these is necessarily directly on the paycheck. So you have to do a little bit of investigating and some deeper thinking. All right. For net pay per month, again, a common mistake is just to blindly go in and say, well, the net pay on this paycheck is $3,248.38. So that must be his net pay per month. Problem is that you didn't take into account the pay period of the paycheck, right? If this was for 1 week, that wouldn't be his monthly net pay. If it was for the entire month, then it would be. So we need to pay attention to the pay period. All right. In this case, it's September 16th through September 30th. So we know that it's not a weekly paycheck. We also know that it's not a monthly paycheck. Now we need to distinguish. Is it biweekly, meaning is it covering 2 weeks, or is it semi-monthly, covering half of the month? So 16th through the 30th is a range, so we can't simply take 30 minus 16. If we did 30 minus 16, that'd be 14, and we would want a common mistake would to look at that and think, well, that's 14 days, but it's not. Okay, because we're not actually taking out 16 days. We only need to subtract out 15 days, September 1st through the 15th. The 16th is included in the paycheck, which is why if you treat this as a subtraction, you can subtract 30 minus 16, but then you always have to add 1 back to it. All right, we could count it out, right? 16, 17, 18, 19, 20, that's 5. 21, 22, 23, 24, 25, that's 10. 26, 27, 28, 29, 30, that's 15. So this paycheck covers 15 days. Just like if we had looked at the paycheck immediately before this, right? Would have been September 1st through the 15th. Well, when we start at the beginning of the month, it's really easy to look at a paycheck and see if it covers the 1st through the 15th. Well, that's 15 days, right? But if we did the subtraction, 15 minus 1 is 14 days, we would know that that's not right. Same thing happens for the next 15 days within the month. All right, so this covers 15 days or half a month. That suggests to us that he's being paid semi-monthly or 2 times a month. So when we have questions about his net pay per month, we would take his net pay on this paycheck times 2 because he's going to receive 2 paychecks during the month. So 3248, 38 times 2 to account for the entire month means his net pay for the entire month will be 6496.76. Okay, and then similarly for Part B, what's Richard's annual salary? We can take his salary on this paycheck, 4938.50. Okay, but again, because he's being paid semi-monthly, that's 2 times a month or 24 times for the full year. We would need to multiply that by 24. So 4937.50 times 24 would be 118,500 for the year. All right, last one for this page, number 12. Stanley Hudson works under Mifflin in Scranton, Pennsylvania. Stanley is paid on an annual salary of $68,300 and is paid monthly. He makes the following contributions: $400 to retirement, $350 toward health insurance, $100 toward a flex spending account, and then we're given the tax percentages. All right, so for Part A, what is Stanley's gross pay for the pay period? So again, he earns $68,300 for the full year. The year is broken up into 12 pay periods because he is paid every month. So 68,300 divided by the 12 pay periods means that each pay period has gross pay of 5691.67. Part B, what's Stanley's taxable gross pay? So we're going to take the gross pay on the pay period 5691.67 and we're going to subtract out his voluntary pre-tax deductions. In this case, it's his retirement contribution, his health insurance cost, and the contribution to the flex spending account. So 400 and 350 and 100 means that $850 is being subtracted or deducted pre-tax. So 5691.67 minus that 850 equals 4841.67. Part C will be deducted for Social Security. So now we're taking the taxable pay for which was $4,841.67 times the various tax percentages. For Social Security, 0.062 gets us to $300.18. For Medicare, that amount times 0.0145 gets us to $70.20. For Part C, for federal income tax, we're going to take his taxable earnings times 0.15, which equals $726.25. And then what will be deducted for state income tax? If we come up here, we see that Pennsylvania has a state income tax of 3.0%. So his taxable earnings times 0.0307 is $148.64. All right, we add up all of those tax deductions. We subtract that out from his taxable pay, and we're going to get his net pay. So his taxable pay is $4841.67 minus those taxes, which together add up to $1,245.27. Okay, we subtract those deductions out, we're left with $3,596.40. All right, almost done. Moving on to the last page. We're faced with a couple of examples again of calculating taxes using tax brackets. So again, we're given a tax table, various percentages, dollar ranges, and standard deduction. 13 says Lincoln, a single filer, has a gross income of $94,050. What is their taxable income? So we're going to take that $94,050, right? $94,050 minus the $12,400 standard deduction leaves us with $81,650 in taxable earnings. Looking up at the brackets, 81,000 falls into the 22% range. All right, so 10% of that first range, $99.50, gets us $995. 12%, Lincoln is going to fill up that entire second bracket. So the upper limit is $40,525, but $99.50 were in the previous bracket, so we subtract that out, meaning this range has $30,575 in it. 12% of that is $3,669. And then finally, the remaining dollars are going to fall into that 22% bracket. So the last taxable dollar that they earned, 81,650 minus the dollars that were already taxed. So the upper limit of the previous bracket, 40,525, leaves us with 41,125 in that range, or $9,047.50 of tax for that bracket. We add those three up, we round to the nearest dollar, and we see that the total tax due is $13,712. All right, next one, Alex and Jen are married and filing together. Their gross income is 198,400 with a standard deduction of 24,800. So what is their taxable income? We simply subtract that deduction from their earnings. We're left with $173,600. Looking at the brackets, 173,000 just gets us into the 24% bracket. So this couple is going to fill up the 10%, fill up the 12%, and fill up the 22% brackets, and have a few dollars left over that spill into the 24% bracket. So they max out that 10%. Okay, that range has 19,900 in it. 10% of that is 1,990. The 12% bracket maxes out at $81,050. And again, 19,900. We're in the earlier bracket. We subtract that out. That range then becomes 61,150. 12% of that is 7,338. They also fill up the next bracket of 22%. So that range maxes at 172,750. $81,050 were already taxed in the earlier two brackets, leaving us with $91,700 in that bucket. 22% of that is 20,174. And then the last few dollars spill into the 24% bracket. So the last taxable dollar that they earned was 173,600. 172,750 were already taxed earlier at the lower brackets. So that's $850 falling into this bracket. 24% of 850 is $204. We add those taxable dollars up, and in total, the total tax due is $29,706. All right, finally, Sam is a single filer, gross income of 108,270 with a standard deduction of 12,400, means that their taxable income is $95,870. Looking up in the bracket, 95,000, similar to the last problem, gets us into the 24% range. So they're going to fill up the 10%, 12%, and 22% brackets. The math is up there. All right, so for the 10% bracket, they'll owe $995. For the 12% bracket, $3,669. And for the 22% bracket, they'll owe $10,087. All right, the remaining dollars fall into the 24% bracket. Again, they maxed out in terms of taxable earnings at 95,870. We subtract out the 86,375 that were taxed earlier, leaving us with $9,495 in that last range. 24% of that is $2,278.80. Adding up those that tax due and rounding to the nearest dollar gets us $17,030. All right, so last thing about this, just so that everybody's clear, and I want to make sure that you're aware of this, in the Unit 2 folder, in the 2.99 unit review folder, all right, there is the Unit 2 worksheet answer keys subfolder. Everything that we've done up to this point for this unit, the answer keys are there. So if you need to go back and review anything, if I went through too quickly or if you missed something earlier in the unit, all of those answer keys are there for you to look at and review. Additionally, the 2.99 review worksheet, the answer key is posted here as well. So again, if I went through this too quickly, if you missed anything, in that 299 review folder, there's the worksheet answer key subfolder, the review worksheet that we went over, and then the review answers are immediately below that. So if you click on that, you'll see that this will pop up and you can click through each page. All right. So next time we meet, we'll have the Unit 2 assessment. So please let me know if you're struggling with anything, if you have questions, if you are uncertain on anything at all, reach out to me. I'm happy to help. I'm happy to create more examples or samples or practice work for you, or just answer any concerns that you may have. So reach out to me. Otherwise, take care of yourselves, take care of each other. We'll talk soon. See you, everybody.